Hello, welcome to our November Outlook and Positioning video. My name is Derek Varner. I'm joined by my friend and colleague, Mike Allison. Hello, Mike. How are you?
I'm great, Derek. How are you?
Well, thank you. So, thank you for joining us. In this video, we're going to give you an update on what's been happening in the market and the economy. So first, we'll start with performance for the month of October. We saw a continued rally in technology companies. So, the NASDAQ, for example, which has a lot of the who's who of large technology companies like Apple and Microsoft and Nvidia, gained about 5% during the month of October. The S&P 500, which tends to be a more blended, balanced allocation of large cap U.S. companies, up about 2.5%. And then other parts of the market, like foreign securities, up about 1.2%. Small cap U.S. companies up about 2%, and then bonds up about 0.5%. So generally a broad-based positive month in the markets. So what do you attribute that to, Mike? What did you see that kind of went well in the month of October and led to some of those gains that we've built on throughout 2025?
Well, I think a lot of it is what it's always been, which is earnings driven. And so, in general, companies have been reporting uh, solid earnings for Q3. In particular, the so-called Mag 7 or the large megatech companies. And I think that's driven performance. There's also, increasing, market cap weight, which is as flows continue into index funds, for example, they disproportionately or incrementally benefit the largest weighted companies in that cap weighted index, and that's something we can talk about in future months. But I think it's just generally been about earnings.
Yeah, so let's go right there then. That's a good point. So we've gone through a few weeks of earnings season for the third quarter. So in the month of October, for you can see here on screen, we have about 324 of the 500 S&P 500 companies have reported earnings. And generally, I know there's a lot of numbers here, but the real takeaway I would ask you to look at is that earnings growth, as Mike said, year over year has been very positive, up about for the index so far for the companies that have reported, up about 11% year over year. So companies are earning 11% more on average year over year in the S&P 500. And you can see that's really broad based across lots of different sectors, parts of the economy. So not just in technology and communication that you hear about and are sort of adjacent or directly related to artificial intelligence, but broad-based across lots of different sectors. And then the earnings surprise, which is also important, it was about 5% above Wall Street expectations. So in other words, corporations on average outperformed what Wall Street had been anticipating going into earnings season.
Derek, it's worth pointing out if you look at the earnings growth, the two largest sectors are technology and financials. So that's, continued to support the overall market, but certainly those largest tech and financials.
So let's go to tech then. I think that's a good place to go next. So we've seen a continued build out in artificial intelligence infrastructure, and I think investors have really rewarded this behavior with higher multiples, and the companies have continued to, as we just saw, continue to enhance earnings. And what we've noticed is that a lot of the capital spending that's happening in the economy is being driven by those biggest kind of artificial intelligence related investors. And there's actually been a decline in kind of other companies investing in capital improvements to their businesses. And the other thing that we've noticed is these companies, which had traditionally been very what we would call asset light, technology businesses that don't require a lot of hard infrastructure to make money, that's really changed over the last few years. So these companies are really being required to invest heavily into physical assets like data centers, which could be a very, very good thing for those companies and for the economy in general in the future. But it does present a kind of a step change for their earnings and the types of businesses that these companies represent for investors. But Mike, any thoughts there?
Yeah, I think that's something to be mindful of as this continues. the complexion of these companies' profitability and free cash flow characteristics is changing. And, arguably one would expect that to get reflected in multiples at some point. It hasn't really yet, although we did get signs recently when Meta reported their third quarter earnings, and their CapEx guidance went up, and the market was not didn't treat that well, or didn't take it well. And so I think that is maybe something that we have to continue to watch, because as the profitability and free cash flow characteristics of these historically extremely profitable and free cash flow generative companies is evolving through this CapEx cycle, we have to be mindful of what that means for valuations.
Good point. So let's go to valuations then. And, I would be remiss if we didn't mention that the S&P 500, which is, a component of a lot of client portfolios. It's kind of one of those main bellwethers that we track and you see on the news each night. It is trading at its highest level on a forward earnings, price to forward earnings basis since the dot-com bubble. So that's something that we're continually watching and tracking, that, is there a risk here in this part of the market with these stocks? Investors they're making a lot of money. Investors are rewarding that. They're investing a lot of money in new infrastructure. But is there a risk? Have we seen this movie before? Mike, I know you've written a lot about this in different pieces that you've published. I'd love to hear your thoughts on kind of where we are in this cycle. Is this a risk? Should we be concerned? Where are we?
Well, it's a good question, and I think it's one of the most important ones to ask and think about. Where are we in this structural CapEx cycle, which is akin to the dot-com bubble, which was really more than dot-com. It was really about the build out of the commercial internet infrastructure, which was telecom related and others. We have a similar situation going on now, where we've got this kind of secular and structural shift that's requiring a lot of capital to be deployed. Where are we in that cycle? I don't think we know the answer to that, but my sense is that it's not the eighth or ninth inning, but it's also not the second or third inning. So I feel like we're sort of in the middle of that, and I think that the more that time goes by, the more stretched some of these companies will be in terms of funding this, and we're starting to see very large, you know, um, debt offerings, for example, which is something these companies never had to even think about. And so I think that some of the earnings quality issues that came and showed themselves towards the end of the internet bubble, we're maybe starting to see the very first signs of some of that in this cycle. And so that's something to be really focused on, is earnings quality, balance sheet quality, and or degradation of balance sheets. And I think that's where the signs will appear that maybe, there's a pause or a slowdown in this very, very rapid growth cycle.
So you've got a few canaries in the coal mine you're watching.
Yeah, I think the the market, and historically people are very focused on the income statement, but the real trouble will show itself in the balance sheet and statement of cash flows as companies start to really get creative in the not positive way
Right.
with their financials.
Well, and I don't want to be overly alarmist about it. So one of the things
Agreed.
that I think is
Agreed.
important to point out is that, these stocks, they are hopefully changing the world for the better by investing in this new technology, but they only represent a portion of the available investable kind of opportunity set. So client portfolios typically include other asset classes like value stocks and dividend stocks and small cap and foreign and emerging markets and bonds and hedge funds and a whole host of things that we put together in an effort to help smooth the ride toward achieving long-term client objectives. So the point I would like to make here is that we really view artificial intelligence as we've mentioned in past videos, we've written about it a few times, as a long-term technological revolution that's going to benefit lots of different parts of the economy, lots of different companies. So we think that, by even by investing in areas outside of the Magnificent Seven, as they're referred to, we think clients will still benefit from that revolution over time, over the next few years and decades to come. So a lot of the stocks that we invest in, we think are poised to benefit from, whether it's efficiency gains, revenue, potential sources of new revenue, et cetera. And that's what we're watching out for in an area where we think some of those larger technology companies look increasingly expensive.
And I think that's the broader point, Derek, which is, as with the internet and the build out of the internet, it drove over a long period of time dramatic productivity increases, which drove, economic growth. And my view is that we're going to see something similar play out over the course of time with as we learn more broadly how to incorporate artificial intelligence into a variety of areas, which will enhance productivity growth and therefore economic growth. And that may or may not be a function of the stocks that have performed so well in the last few years.
Well said. So we'd be remiss if we didn't talk about the U.S. government shutdown. So I think we were recording this on November 4th. It's election day. And I think we're approaching the longest government shutdown in history. The previous one was about 35 days, and we're approaching that at this point. So, candidly, we don't have complete clarity into what could resolve the shutdown. We're starting to see pain points in terms of federal workers, missing paychecks, folks, like air traffic controllers not showing up for work and creating kind of lots of challenges for travel. And so we're starting to see the pressure ramp up. But Mike, what are your thoughts on kind of where we are, in terms of the government shutdown, and what could resolve it? What are you most concerned about?
It's hard to pinpoint. I think it's an indication of really kind of a dysfunctional Congress, which we've you know has to change at some point. Right now, it's just a stalemate between two very stubborn positions. And regardless of your view on those positions, the reality is that something has to give. And maybe it's as simple as today's election day, and there are some consequential elections in Virginia, in New Jersey, in New York City. And maybe the political reality is that after election day, when all that dust settles, then the political pain of this sort of stalemate becomes too great, and then this gets resolved. And then on the other side of that, who knows what that means in terms of the impact of this shutdown. Historically, government shutdowns have been kind of a nuisance, but then once they're resolved, it was like it never happened, no big deal. That may or may not be the case this time. I'm not sure, and I don't have the answers.
So let's wrap up with our economic dials as we always do. So we didn't make any changes this month. I know we heavily debated changes at our investment committee meeting, but we see the economy continuing to grow. And again, that's really driven by heavily by the investment in artificial intelligence infrastructure. We're seeing some softening in the employment market, so we've had that listed as neutral for a few months. And then similarly on the household side, we continue to see consumers, they have jobs on average, they're spending, but feeling stretched by continued higher costs. So that's something we're watching on the economic side. Financial conditions generally trending in the right direction. The Fed has resumed their path toward lowering interest rates. We got another interest rate cut in the month of October. So that's moving in the right direction. And inflation has been tame, not as low as I think folks would like it. And we're seeing some movement higher in certain areas. So that's something we're watching. We still list as neutral. And then we talked about the market, with valuations we list as neutral because of that bifurcation between technology companies being, maybe elevated and the rest of the market looking closer to long-term average, but earnings being very good, and the trend has been generally higher. But Mike, I think what we said before we started recording today was, it feels like we're entering an era where some of the risks that are out there aren't being fully reflected in prices, particularly the prices of some of those technology companies. So, what are some of the key risks that you're thinking about and watching beyond ones that we've talked about today?
Well, I think in addition to, the earnings quality risk of those largest tech companies, we talked about the government shutdown. Maybe that has some impact on the other side of it or not. Another thing that's probably worth considering and thinking about and watching is on the tariff front. Sort of the market has accepted over the last several months that the tariff situation is what it is, and it's not that bad, and the market can and the economy can kind of power through the tariffs that are out there. And there's been a lot of agreements between the U.S. and various countries. But now we have an upcoming Supreme Court case, which could throw all that up in the air, which challenges the administration's ability to impose tariffs, sort of unilaterally and by fiat. And then, so if that gets overturned, and there has to be some measure of retrenchment in all of these tariffs that the market has sort of settled into accepting. If that all goes by the wayside or gets modified from what it is today, that is an uncertainty and a risk that's certainly not reflected in my view in the valuations. I think that changes the trajectory of the dollar. Sort of the market has accepted a weaker dollar and stronger non-US equity performance and those sorts of things. If you have tariffs kind of get thrown up in the air, then you're going to have I think a significant rebound in the dollar. And if that happens, that reprices a lot of different assets. And so that's something that we have to really be focused on. And, it's a shame that we are sort of in this world where a court case can determine, how assets perform. But, here we are.
Yeah, that's well said. So yeah, there's never a shortage of uncertainty, but I think that we still see lots of areas of opportunity, and we continue for most clients to hold a balanced, diversified portfolio to help kind of weather any shorter term periods of uncertainty and volatility. So thank you, Mike, very much. Excellent as always. I appreciate your thoughtfulness, and thank you all for watching and trusting us with your wealth. And please reach out if you have any questions or would like to discuss any of these topics in greater detail. We welcome your feedback, and we look forward to seeing you again next month.
Thanks, Derek. Thanks, everyone.